Hello, and welcome to an exploration of long-term capital management, LTCM, once revered as the pinnacle of quantitative finance, staffed by top-tier PhDs, Nobel laureates, and a distinguished Wall Street pedigree. Founded in 1994, LTCM quickly amassed billions of dollars, promising stable returns through sophisticated arbitrage strategy. By 1998, though, the fund hovered on the brink of collapse, forcing a Federal Reserve organized bailout to prevent the crisis from spreading to global market. This is the story of an extraordinary hedge fund undone by overconfidence, extreme leverage, and unforeseen market events. In the 1970s and 1980s, breakthroughs in financial mathematics, like the Black-Scholes option pricing model, inspired traders to harness rigorous quantitative methods. By the early 1990s, quants specialized in using advanced models to exploit tiny market inefficiency. Many believed that, with enough computing power and theoretical skill, systematic trading could outsmart traditional approaches. John Meriwether, a renowned bond arbitrageur from Salomon Brothers, formed LTCM in 1994. He recruited Myron Scholes and Robert Merton, both Nobel Prize winners for their contributions to option pricing theory, along with other star academics and traders. Investors clamored to invest, captivated by LTCM's pedigree and the promise of near risk-free returns through complex derivative strategy. By the mid-1990s, hedge funds were ascendant, luring money from pensions, insurance firms, and wealthy individuals seeking superior yields. LTCM fit the moment perfectly. It portrayed itself as a safer bet than typical long-only funds because it supposedly hedged out market exposure, relying on arbitrage spreads instead. The fund's exclusive aura, high minimum investment, further boosted demand. LTCM favored convergence arbitrage, identifying mispricings between related securities, like on-the-run versus off-the-run treasury bonds, or similar sovereign debt from different countries. The fund bet that price spreads would converge to historical norms. While each spread might be tiny, LTCM used massive leverage to amplify small returns into large profit. Leverage is crucial to understanding LTCM's eventual downfall. The fund borrowed heavily, up to 25 or 30 times its capital, to magnify return. Investment banks happily extended credit, trusting LTCM's Nobel Prize aura and track record of success. Though profitable for a while, such extreme leverage meant even slight market changes could deplete LTCM's equity rapidly if trades went in the wrong direction. At LTCM's core were models rooted in historical correlations and volatility assumptions. These models predicted that certain spreads would revert to the mean over time, rarely deviating significantly. However, they often neglected outlier scenarios. LTCM believed its diversification across thousands of positions in multiple markets reduced the chance that all would fail simultaneously. In hindsight, the approach underestimated systemic events that can cause correlated market moves. Starting in 1997, Asia faced a major financial crisis, currency devaluations in Thailand, Indonesia, South Korea, and beyond. Global investors fled risky emerging markets. This initially created some dislocation LTCM could exploit, but also signaled that unpredictable cross-border contagion was possible, something LTCM's models downplayed. In August 1998, Russia unexpectedly defaulted on its domestic debt and devalued the ruble, roiling international markets. Investors scrambled for liquidity, dumping assets in a flight to quality. LTCM's positions, which assumed stability in global bond spreads, were hammered. So-called safe trades unraveled as risk aversion soared and correlations rose, defying LTCM's historical data. Within weeks, LTCM's capital base was battered. Trades in Europe, Asia, and the Americas all went sour as risk premiums spiked. The fund's equity fell from over $4 billion to under $1 billion, yet it had $100+ billion in positions plus hundreds of billions in off-balance sheet derivatives exposure. Banks demanded more collateral. LTCM, with no quick fix, teetered on insolvency. By late September 1998, concern reached top U.S. policymakers. If LTCM defaulted, it might force banks and counterparties to dump huge positions at once, possibly triggering a cascading collapse. Then, Federal Reserve Chair Alan Greenspan worried about systemic risk, reminiscent of events leading to the 1929 crash. Federal Reserve officials convened an urgent meeting with leading Wall Street banks, Goldman Sachs, J.P. Morgan, Merrill Lynch, and others. They hammered out a plan. A consortium of creditors injected $3.6 billion into LTCM in exchange for controlling stake. The arrangement stabilized LTCM's positions, avoiding a fire sale. While not using taxpayer funds directly, the Fed-facilitated rescue was labeled a bailout by critics who argued it created moral hazard, the perception that big, interconnected hedge funds wouldn't be allowed to fail. Proponents countered that letting LTCM crash would have caused far more damage to world market. Post-rescue, LTCM's new overseers unwound its positions carefully, minimizing additional market shocks. The fund eventually dissolved, paying back a portion of investor capital but with major losses. LTCM's founder John Meriwether and the Nobel Prize economists departed, their reputations dented. Regulators worldwide realized that lightly supervised hedge funds could pose systemic risk. Though LTCM was a hedge fund with under $5 billion in capital, its leverage and counterparties spread risk throughout finance. The crisis highlighted the need for improved reporting, stress testing, and oversight, especially for heavily leveraged players. LTCM's downfall might have been overshadowed by the 2008 financial crisis, but it provided a rehearsal of sorts: advanced financial models failing under extreme market stresses, central banks stepping in to avoid contagion, and moral hazard concerns about too interconnected to fail institutions. Many believe LTCM was an early warning that markets could still fail spectacularly despite sophisticated risk models. Long-term capital management was a high-flying hedge fund that, at its apex, seemed unbeatable. Its roster boasted intellectual luminaries who believed in mathematically guided arbitrage. But in reality, LTCM's use of massive leverage and its assumption that historical correlations would hold proved disastrous when global markets veered off script in 1998. The near collapse prompted an extraordinary Fed-mediated rescue, underscoring that even private funds can be so entangled in the financial system that their downfall shakes the entire infrastructure. The LTCM incident forced regulators, banks, and investors to reckon with the fragility of seemingly bulletproof strategy. As we reflect on modern crises, LTCM remains a cautionary tale. Hubris, overleverage, and an over-reliance on models can sow seeds of a meltdown, no matter how brilliant the minds behind the trades.